Good evening, dear colleagues. As always, this is ForexTimes, and I'm Dan Strelkov. I traditionally invite you to join the ForexTimes community to see the strongest support and resistance levels, as well as strategic target levels, based on data from the Chicago Mercantile Exchange, which you won't find in any other projects. Let's start with the euro. According to the Commodity Futures Trading Commission, CFTC data, there's been a 10% increase in buyers, which suggests we should consider buying. However, there are always two scenarios to consider, and one of them I like very much. Let's call it the first scenario. This scenario involves the continuation of the instrument's decline on Monday, Tuesday, and the first half of Wednesday. This decline could reach a strong support zone formed by HDO options puts and the market makers' loss level at 120 million and 79 million respectively. If a buy pattern forms, like a pin bar or an impulse correction, we can enter the market with pending buy orders buy stop. If a pin bar forms, we enter with buy stop orders and place a stop loss below the pin bar's low. In this scenario, we would work through the ABC correction waves and then enter the market aiming for strategic levels. We might reach the 1.1 level within 1 to 3 weeks, where there's a concentration of options contracts worth 220 million, forming a strong resistance zone. This level is close to the market maker's upper range boundary. It should also be noted that near this level, professionals had previously indicated options contracts worth 209 million and $210 million. Recently, another $220 million has appeared. Therefore, dear colleagues, we are considering only buying, and I prefer scenario one. However, there is a catch. It's hard to reconcile the CFTC data showing an increase in buyers with this scenario because the trend is upward and there are 10% more buyers than sellers. This suggests we should buy almost from the current positions, but I propose waiting for a correction before buying. So what should we do? To buy after a correction, we need to ensure this figure is an impulse. Unfortunately, we can only construct an impulse if a likely initial diagonal triangle forms. Here's how it would look. The first wave is divided into 3, the second into 1, the third into 2, the fourth into 1, and the fifth into 3, followed by a correction. So this is wave 1, a correction, wave 2, and only then do we consider entering wave 3. This scenario is also valid, friends, and we will definitely work through it if we see the formation of an initial diagonal triangle. If we see this formation, we'll set a buy stop order after the correction, smile and wave. The first scenario I proposed is activated if the price starts updating its minimum values on Monday. Then the price drops in a zigzag pattern to the market maker's loss level, works through the $120 million and $79 million levels, and then reverses to aim for the 1.1 target level. Actually, regarding gold, it's roughly the same situation as with gold. Yes, by the way, globally, I think you remember that gold in general very clearly shows that it wants to turn around. For the past 3 months, the bears have not been letting the bulls up. All the time we see a reaction on the weekly time frame. There is a beautiful bearish pin bar with liquidity absorption. That is, liquidity in the form of stop loss orders and pending orders by stop were absorbed. A big player consumed all this liquidity and even added more to push the price down. This indicates that the decline is highly likely not yet over. Additionally, dear colleagues, we most likely have a final diagonal triangle forming. We are now either at the end of wave 3 or at the very beginning of wave 4. This will result in a very deep decline, at least to the target level of 2075. This is the minimum target for the simple reason that wave 4 is bound to absorb wave 1 in an ascending diagonal triangle. Therefore, 2075 is the minimum target level for the decline. The only question that remains is, has this decline already started? At this point, there are questions to consider for the upcoming trading week. I suggest there are two options, and I prefer option 1. According to the Commodity Futures Trading Commission, we are seeing a 7% decrease in buyers and a 7% decrease in capitalization. This indicates that professionals who were buying are leaving the market and taking their money with them. This is understandable, but the decrease in buyers rather than an increase in sellers suggests that the trend is still upward. There are still more buyers than sellers in this market. Let's look at the structure 1, 2, 3, 4, 5. This is most likely an impulse wave in a correction, followed by a corrective wave. The question remains, has wave C already ended here, or will we see the formation of the final diagonal triangle? I mention this because we have a very strong support level from put options and option contracts totaling $75 million. Therefore, if we see the formation of an ending diagonal triangle, it will be excellent. Next, we should either place a pending buy stop order above the end of wave 4 or wait for an impulse correction and then enter with a buy stop order. Why buy? Over the past trading week, professionals added option contracts worth $200 to 430.94 and $250 million. Meanwhile, they only added $75 million at lower levels. Therefore, I assume we are ending the ABC downward correction and might still test this range. For the upcoming week, we have two options, similar to the situation with the euro. Option 1, the correction has already ended, 1 to 2, 3, and now we are heading up. There are three possible scenarios. Option 2, we are going up. How? We need to find the impulse in the current market structure. It's not here yet, but it could form. If we see an initial diagonal triangle followed by a correction, we can place pending orders to buy. The third option suggests that we will continue the decline without any retracement or testing of the options call contracts range. Therefore, this movement is wave number 1, this is wave number 2, and we are working on wave number 3. The movement will go down regardless of support levels. I apologize, but it's absolutely not considering anything. Therefore, I always say that a support level is not a level at which you should buy. It is a level where you need to look for patterns to enter the market, either through liquidity absorption patterns or impulse corrections with pending orders. So if option 3 is correct and we are starting a global downward movement, then within it, there is still sub-option 1. We cannot do anything with it except place a pending sell order here, attempting to catch this movement. However, I wouldn't do that. The reason is that not only do we have a support level in the form of a hedge and options contracts at $75 million, but we also have the lower boundary of the profit range for the market maker, i.e. the market maker's loss level. Therefore, if the price moves below this level, the market maker will try to bring the price back by the expiration time, which is Friday evening. Thus, the deeper the price moves down, the higher the likelihood that the market maker will push it back up. There is also another sub-option. If we are indeed in wave 1, 2, and we are currently working on the third impulse wave, an initial diagonal triangle could form in wave A, followed by a correction in wave B and an upward movement in wave C, thus forming 3 to 4, 5 in the corrective wave 2 of a lower degree, and then waves 3 to 4, 5 of a higher degree impulse wave. This is another sub-option, dear colleagues. So the option with the initial diagonal triangle can be present in both scenarios. If we test the hedge and the $75 million options contracts on Monday, Tuesday, or the first half of Wednesday, then we will look for buy patterns. For the S&P 500, dear colleagues, those who are selling pray for a triangle formation. The reason is simple. If a triangle forms here, we can confidently say that we have the first impulse wave, second corrective wave, third impulse wave, fourth corrective wave in the form of a triangle, and fifth impulse wave, after which there will be a correction and a deeper decline. Therefore, if a triangle starts forming on Monday, Tuesday, or the first half of Wednesday, you can consider placing pending orders for sell stops under wave A. However, if we see the current trading instrument rising, it is likely that this movement in the form of a zigzag was a simple correction, ABC, and the S&P index will continue rising as such. So be extremely cautious and monitor what forms here. If it's a triangle, we continue to fall. If impulse growth continues, 1, 2, 3, 4, 5, after the correction, we will switch to buying. Thank you very much, dear colleagues. I hope I have been of some help. Once again, I invite you to the ForexTimes community. Come by, you won't regret it. Have a great evening and goodbye.